Hey everyone, it is Wednesday, and of course, Wednesday means we bring back your favorite expert, Anna Kelly. How you doing?
I'm great this morning, Michael. How are you?
I'm doing very well. So we've gotten some comments recently on my channel about people, I'll call it concerned about the future for taxes and inflation. And now I realize those are big umbrella, but let's try to tackle both, and I'll let you choose which one we talk about first.
How about taxes?
All right, let's talk about taxes. So one of the things that I think most of us could assume is we are going to have to pay for this health crisis somehow, some way. And local, state, and federal governments don't produce anything. So their only vehicle for revenue is taxes. So I think
Yes,
it's fair to say that taxes are going to go up, as are fees.
yes.
When you think of that and you think of how we play the game in real estate, when you think about taxes in the future, what are your initial thoughts?
My initial thoughts is, Michael, taxes are already a significant portion of the expenses of owning real estate. And so
Hmm.
they already make up, a good 20, 25% in some states, even 30% of the operating expenses. So they're already significant. And as taxes go up, theoretically services are supposed to go up. Your area is supposed to be improved with better roads and better lights. And when municipalities are already struggling, as most have been in the United States, a lot of people don't realize that already they're not being able to balance budgets. They're going further and further in debt locally, many states. Already they're not providing a lot of those services because they just don't have enough income for what they spend.
Yeah.
So now this crisis is giving them an even further, expenditure list and a bigger budget of things they have to pay for. And they are already suffering. So they're going to have to raise them quite a bit. So,
Hmm.
it's not something I'm happy about. And I think ultimately though, what typically happens is, as an investor, you say, well, if taxes go up, my expenses go up, and I still need to make a profit, what are we going to do? We're going to raise rents. And
Hmm.
as long as we have the ability to raise rents, unfortunately, the cost of living for people that rent is going to continue to go up because we ultimately have to pass that through. Where it really becomes scary, Michael, is the things we're seeing, we've seen in a lot of big cities is rent controls and rent
Yep.
caps. So if you're in a city like New York City, they instituted rent controls and rent caps, and it demolished, commercial real estate.
Hmm.
Values started to dip because people couldn't sell. So if you have rising taxes and rent caps, your profitability, which is already typically only about 9% of every dollar that you bring in,
Hmm.
net as an operator, will just continue to go down. And so it's something we have to think seriously about, and that isn't a positive.
Yeah, definitely rising taxes is not a positive, but I think is unfortunately a reality of what we're going to go into. And then the other
Right.
reality is once taxes go up, they really rarely come down, right? So if
Yeah.
there's that whole talk. But really, when I think about the business of real estate investing, there's lots of ways they can get us, right? There's obviously property taxes, which probably most people think about. And property taxes, there's fees at the state and city and municipality level. So look for those to go up probably almost everywhere.
Right.
Uh, but there's also, they can come at us for operating the business of real estate investing, whether that's the 1031 exchange, which we can talk about separately. I was leading this discussion around depreciation, right?
Mhm.
There are loopholes that if they really got, I don't know, call it aggressive, call it nasty, call it whatever you want, they could remove depreciation as a non-cash expense. I mean, I've never
Yeah.
heard that talked about, but I mean, it could get that bad.
Yeah. And I think the reality that we have to think about as an investors, and that 9 cents for every dollar profit margin number is a number that a lot of people don't realize. But
Hmm.
I've studied a lot, as people were talking about rent moratoriums on evictions,
Yep.
letting people just not pay until the end of the year.
Yep.
It's like, okay, most property owners only operate on about a 9 cents per dollar profit margin. And
Yep.
so what happens is, if you look at what financial advisors will tell you, which we've talked about before is not necessarily the right number, but supposedly you can put your money in the stock market for the long term and make about a 10% return. So the advantage to owning real estate as opposed to stock market, aside from control and all those things that we've talked about before, is if I can put my money passively in something and make 9 or 10%, then there's got to be incentives for me to invest in real estate that, oh, by the way, now have new levels of liability and risk and work involved to make it active. Where if I can't make at least 9 or 10% in real estate, I'm going to find somewhere else where I can and do it much more passively without the headaches. So one of the incentives the government gives us is, oh, by the way, in addition to this money that you're going to make on a cash on cash return basis, et cetera, we want you to provide nice housing. We want you to make areas go nice and look nicer. And then, oh, by the way, raise your tax revenue. So we're going to give you some incentives to keep buying real estate, even if you're not making a huge cash on cash return. Those incentives are the bonus depreciation, the low capital gains rates, and the ability to 1031 and continue to roll it over and over again. Because essentially, even though we don't include it in our real return numbers, the tax savings component that you realize on your income is significant. It can be almost the amount of your full investment can be saved in taxes in many instances. So the thought of those things going away, I think, really disincentivizes a lot of investors from continuing to buy real estate, especially if real estate taxes go up, rent controls come in, and now they pull away, all the benefits that make people happy to invest.
Yeah, and the next thing I wanted to go to was one you just mentioned there is they could change capital gains, right, from 20% to ordinary income, which again is a disincentive, right, to really hold real estate. So
and Biden's already talked about that. So Biden's made a statement in the last couple of weeks that he wants to raise the capital gains rates, and he wants to remove the 1031 exchange, which basically eliminates having to pay capital gains. So that's something, the Democrats have talked about for a while, and it tends to be when a Democrat is in office or when the Democratic legislature is primarily Democratic, that you see those tax law changes and you see the rates go up, and then it swings back and the rates drop when there's, more conservatives in office. So the pendulum does go back and forth, which makes it hard for us to plan, hey, when I sell it in a couple of years, am I going to pay it 15%, 20%, or is it going to be 30, 35, 40%? And I think that's, Michael, why we can't really include the tax benefits in our return numbers, like a tax adjusted return, because we really don't know what the rules are going to be at the time that we go to sell.
Yeah, certainly today, I would not include any of that in today's talk. I mean, when I was buying 5 or 6 years ago, it was certainly something I considered because it's kind of felt like it'd been that way for a while and I didn't see it changing. It's going to change now. The other thing that just hit me while we were talking is we have an example, and I think it was the 80s when the government changed the tax laws and it really crushed real estate. Right. We can, as I recall, there were incentives for the rich, think doctors and dentists, as I remember reading about this decades ago, to invest in real estate because they could take the passive loss against ordinary income. Right. That was eliminated in the tax law change. And I think they capped it at, if you made more than 250 or some other number, but they basically took that incentive away. And when they made that tax law change, real estate got smacked, specifically commercial real estate. I mean, fell. I mean, do you recall reading about that? And I don't think either of us were investing then, but I'm sure you've read about it.
I've read about it, as I've become an adult. I was very young at that time, so I didn't know anybody that experienced it. And I love to be able to say that because as someone, inching up over my mid 40s, it's nice to think I was young at one time. But
you're still young. Yes.
So, but I've read about that. Yeah, exactly. And it was part of the big, crisis of the 80s. And so, I think we have a risk of repeat if the tax rules change too significantly too quickly.
Yeah. And again, as I've read about it, and again, we can go back, I'm sure there'll be people that comment on it, which is awesome, but it was really, the legislation or the politicians at the time wanted to remove this tax loophole. They thought the rich, doctors and dentists were always mentioned at the time, were exploiting a loophole and they wanted to crush it. And they did. And then people were forced to sell and lose a lot of real money. And again, I bring this up not because that loophole still exists, but just as an example, if they want to be punitive, they can.
Right.
And they have a history of doing that. So if we have a change in leadership at the top and if there's a sweep in Congress, it could get punitive.
And I think, unfortunately, because of the fact that we just talked, that this pandemic has created a lot of new debt locally,
Yeah.
state, level, and nationally. The only way for them to pay for it is to tax more. And so they're going to go after every tax that they can. And, quite frankly, as politicians, it doesn't look good if they come in and say, we're going to raise taxes on everybody. So if they say to the world, in the media, hey, we're just raising taxes on the rich, we're getting rid of loopholes that have kept them rich and kept you poor for all these years, that's how they're going to frame it.
Yep.
Then everybody's going to go along with it and not realize what's really happening. I think it's inevitable that there is an increase in taxes at every level, in order to pay for all of the additional debt that we've accumulated.
Yeah, just one more thing on taxes, and then we'll go to inflation. The other thing I think is interesting about taxes is I understand how they market it, right? Let's get the rich. Let's get the billionaires. Yeah. Let's get the people worth 100 million, and then it's 10 million, and pretty soon it's a million, right? If they just keep coming. But what we need to realize, and New York, Seattle, and San Francisco are all making this mistake right now. They have Seattle put a target on Amazon and said, we're going to tax you, I think it was 2.4% on your employees that have Seattle as a residence. So guess what Amazon did? They sent a note to everybody who has a Seattle resident and said, hey, would you like to move? We'll help you, right? And then New York is going, hey, we want to tax billionaires. And the billionaires are like, F you, I'm going to live in New Hampshire where there's no taxes. And then San Francisco and California is like, hey, we're going to tax all the millionaires. And we're like, dude, we got options. We're out of here. What I bring that up is you market it to the average Joe that you're going to tax the rich. The rich give you the middle finger and go, we got options. And then they're left with a bigger hole than they started with. So guess what, folks? All of this ultimately ends in a huge middle-class tax raise. That's just how the dominoes fall.
Absolutely. And so all the talk of, equalizing, income, fair income, et cetera, ends up, bringing the bottom quadrant up, and the rich leave, and then the middle class is stuck footing the bill.
Yeah, the bill's going to end up, if you're in the middle class, which I still consider myself in, we're going to get smacked. So be careful.
And then you become not middle class anymore, really, because of tax. So that, that's the reality. And as businesses are shut down and the middle class who own, real estate are shut down, it doesn't look good. So it's super important that at least, a lot of the taxation changes that happen really are at the state and local level. Like the majority of the taxes we pay is at the state and local and school district level for real estate investors. At a national level, I think there will always be some kind of, nationalized incentive for real estate investors because most congressmen own real estate.
Yeah. Oh my God, self-interest. I'm shocked.
Yeah. So it's important, again, to invest in areas that have, a better budget, a more balanced budget, and, that are more fiscally conservative, and potentially live there as well.
Yeah, you brought this up first time. I think we talked about it was 2 or 3 weeks ago. I brought it up again last week, and I think it's really going to become. It's already a trend. I just think it becomes a tsunami of the people with options. Let's just call it what it is: leave blue states and blue municipalities and go red. That's what it says. I mean, if you have the options, and then that just decimates the place that you're leaving, right? It's like, oh shoot, where'd the middle class go? Well, they left, right? At least the ones that had options left. And now, I just can't imagine what happens in a couple of years. Scary.
Yeah, it's interesting. I saw something this morning, Michael, and it was the top 10 states that right now people are moving out of, like renting U-Hauls, moving vehicles, and then the top states they're moving into. And I was surprised that Pennsylvania was actually in the bottom 10 where people are leaving, as much as California and New York.
Wow.
And I don't remember, I think it was more people from New York and then Pennsylvania and then California. I might have New York and California swap, but Pennsylvania was in the middle. Wow. And I thought, I can't believe that many people are moving out. But it's just been recent. And I think part of it's because our governor in Pennsylvania has been pretty draconian through all of the mandates through COVID, and people are leaving Pennsylvania now in droves, which I was kind of surprised to see. I've heard it talked about, but all of a sudden they're upticking, they're moving south, Florida, Texas, Georgia, Alabama, North and South Carolina.
Yeah, I mean, the U.S., this again is the population adjustment, migration, I don't know what you want to call it, is real. And I think the states and cities will look very different in 2 years.
Yeah,
So
I agree with you.
that's going to be interesting. All right, so let's flip gears. So higher taxes are coming, folks. It's, I don't know. I don't really can't call it a fact because it hasn't happened yet, but it's damn near a fact. But let's also talk about inflation. There's a lot of people out there that talk inflation that don't have our history of watching it. Some of them are already calling for the US dollar to have hyperinflation, like Zimbabwe. I'm like, come on, really? You think that's at least a short-term possibility? So let's talk about inflation. I think we need to talk about both consumer inflation and asset inflation, which again, not a lot of people talk about, but both are important. So again, I'll give you dealer's choice, which one you want to talk about.
Let's talk consumer inflation because then that leads to asset inflation to some extent.
Yeah. So when you think consumer inflation, folks, there's obviously stuff reported by the government, CPI and things of that nature. Let's just talk about what you and I spend, right? That's the basket of goods, right? So think gas, think food, think rent, think healthcare. A lot of those things that we spend a big part of our weekly or monthly budget on are going to be rising. And frankly, many of them already are. I don't know if you've seen grocery bills lately, but there's been grocery inflation here recently that people aren't talking about. So when you think consumer inflation, Anna, what are you thinking?
Right. I mean, as there are supply chain interruptions, first of all, like there are through COVID, suddenly it's harder to get things that you need. It's harder to get things shipped, like hand sanitizer, for example. You can't find it. You can't buy it. It's shipped from overseas, and those that are making it here aren't able to make it fast enough. And so guess what happens? It takes longer to produce. It's more expensive to produce. Then they have to ship it across country, so there's more shipping costs. And all of a sudden, when you do get it, the prices go up. So we're seeing that across all kinds of things right now just because of supply chain disruption. But suddenly there's this big demand for more food. People are stuck at home. They're not out working at a job and eating out at restaurants. They're stuck at home and having to eat, and we're eating a lot more. So there's now more demand on food and, at the grocery store, and that demand at some point starts kicking up prices. So when demand is higher than supply, prices go up. When demand is lower than the supply, they still want to sell it, so they got to cut their prices so that more people buy. So in hard times, there tends to be more demand for food, and therefore prices go up. So that's just an example.
Yeah, no, exactly right. And the other one that's really common for a lot of people is gas, right? Gas, oil, right? Said simply, right? The commodity starts at oil and then becomes gas. That saw a dramatic fall, March, April, May, which led to deflation, right? Where gas was cheaper. But guess what? We weren't going anywhere, right? Supply and demand again. But now oil's over $42 as of this morning. I checked it out. And oil is probably on the uptick because, oh, by the way, Southwest Airlines just said travel is up incrementally. We will, offices and universities are trying to open. So we're going to see oil and gas inflation. And oh, by the way, oil is in lots of stuff, especially a lot of construction, right? As a base commodity. So we're also seeing in home construction lumber right now. A lot of that's probably supply chain related, but still we're seeing inflation in the economy today, and real consumer inflation goes up from here, I think.
Right. And it's a careful balance. And I'm not an economist, but I read a lot of economists. And I know that there's kind of this, on one end, they say we're heading for hyperinflation because we printed all this money. For example, we're in all this debt. And on the other hand, they're saying, no, we're at risk of deflation, like significant deflation. And the government's trying to keep us from going into a deflationary spiral that could ultimately end up in more inflation over time. But there's this fine balance of a collapse and a depression, which leads to kind of deflation. And so right now, what I have learned and what I think I understand, but again, I'm not an expert for those that want to argue what I say, is, when governments go into debt, when we have mass printing of money, which is basically what we've done. So yes, our debt is going up, but we're massively printing money. Okay. So now we've got this big debt that we need to pay off. It's in the government's best interest to cause inflation because if they cause inflation, the value of the dollar, inflation means the prices are going up, but the value of the dollar kind of goes down because it has less purchasing power. So if you're paying off debt with dollars that have less value right now, that's actually a good thing.
Correct.
So, but if it goes too far down, then you go into deflationary spiral. So the government wants to cause 2 to 3% inflation per year, so that over time it becomes cheaper to pay off that debt as they can force inflation. So the government's actually said, the Fed, we're going to keep interest rates low until we achieve at least 2% inflation consistently. And the way that they do that is they're trying to make debt cheap, so that even though prices are going up on things, we'll keep spending because we can borrow the money to spend for the things that we want. So that's how they try to regulate between printing money and making debt cheap. They hope that we'll borrow money cheaply because we're a nation of borrowers and we buy things we don't want, that we'll then we'll keep spending. And if we keep spending, that demand goes up, and as the demand goes up, prices go up, we start to see, a little bit of inflation until you're back at hypersupply. So it's in the government's best interest to lead us to inflation, but it's hard to do that when we're so it takes several years to get there, but ultimately they will achieve inflation.
Oh yeah, there's no question inflation is coming. I think we've talked about it before. I think 2020 could be the year of at least some deflation. Right, you just think of the basket of goods inside consumer, right? The consumer index, CPI. One of them is clothing. Clothing is going to be cheaper, right? Because, oh, by the way, we came into this with a huge supply. The spring selling season never happened. That stuff's already made. You got to sell it anyway. So look for stuff to be on sale. Electronics has always been a great example of stuff getting cheaper. It's what keeps inflation low is the electronic component. And then again, right, we have a lot of people not working, and it's just, all of these things probably leads to slower inflation this year. I think deflation will be avoided. But starting next year, as the economy picks up, as I think no matter who wins the election, we have a monstrous infrastructure bill coming, which means another $1 trillion or $2 in debt. And if they get that going next year, regardless of who's in office, we're going to see inflation, because that's going to be a big jobs component. It's going to be a huge consumer of commodities, cement and steel, and it's coming, I think.
Yeah, and what I think we can't miss, Michael, is that you've got this double whammy of the dollars that we bring in are now going to purchase less because goods are more expensive. So our paycheck, even though it might look the same, is actually not going as far. And then, oh, by the way, now we're going to tax it more steeply. Our paycheck, our real estate, everything else. And so what it means is we've got to keep up. We've got to continue to make more money to offset the fact that we've got both inflation and taxes working against us over the next several years. And it's interesting when you look at salaries on an inflation adjusted basis, salaries, even though people are supposedly getting this, annual COLA adjustment or cost of living adjustment for inflation, real CPI has gone up higher than that, COLA rate. And so across most industries, I mean, the minimum wage has almost not changed. And even at the median income level, the salaries aren't really keeping up on an inflation adjusted basis. Even if you're getting raises, you're still making about the same amount after you factor in inflation. So
yeah. And the other thing to talk about with inflation is the other side. So I think you're right. Consumer prices, get ready for them to go up. And again, it won't happen immediately, but it'll be a trend, and the trend will not be your friend. It'll be a friend to the Fed or the federal government, because again, they're paying off debt with cheaper dollars. That's what they want. But yeah, our purchasing power at the street level is going to be less.
Right.
There is another wrinkle with inflation. There's something that you and I will likely benefit from immensely, and that's asset price inflation.
Yes. That's the good part. That's the gold at the end of the fuzzy rainbow. So,
So let's talk about asset price inflation, because I don't think the average consumer thinks asset price inflation.
Sure. So essentially, if my cost of operating a building, for example, let's just because we buy real estate, if my costs go up, then rent prices are going to go up because I've got to cover those costs.
Mm-hmm.
And if rent prices go up, my NOI, my net operating income goes up, which means the value of my property goes up because properties, commercial properties, are basically essentially valued based on a cap rate or the rate of return that investors demand for investing in that asset as a factor of the income that it generates. So at least for apartment investing, for example, where everything is based on NOI, rents go up, my asset prices go up. When it comes to single family houses, I think you see the same general trend. The risk is that in different areas, if taxes get too high and
Mm-hmm.
the rent caps are too high, then people want to sell them. And then those prices, those values could actually come down.
Mm-hmm.
So with single family, it really is important where you invest because if rents can keep up with the raising expenses, the values of those properties will go up. And if
Right.
they can't, the values of those properties will come down.
Yeah. The other thing I'll say about residential, because that's where I play a lot, is
Yeah.
watch population. Because again, like we talked
Yeah.
about earlier, we are going to see a shift in the United States. We are seeing the big states, California, New York, easiest. You talked about Pennsylvania already seeing outflows. We need to watch this. This is not a trend that will start and stop in a quarter. People don't generally make life-altering decisions like moving easily.
Right.
And they very rarely move back. It's not like I'm going to leave Pennsylvania, go to Florida and go, oh, I don't like Florida, I'm going back to Pennsylvania. That's not usually an option, right? So this tilt or movement is something to watch. So I'm watching population. As you know, I'm a California investor, which lots of people laugh at, but realize I'm a Fresno, California investor.
Yes.
Fresno is like this little haven of red inside a big state of blue. And we are already seeing population increase in Fresno. And the income is going up because we're seeing high income earners go, you know what? I'm done with the Bay Area. I can get to Fresno in 2.5 hours, buy an easy car, easy freeway, not over some silly mountain. And if I got to come to the office once a month, so be it. I'll drive or fly. You can even fly for 45 minutes or whatever it is.
Right.
So again, watch population because I do think there are some cities that will have deflation in real estate values. Again,
Yeah.
New York and San Francisco. It's coming, folks.
Right.
San Francisco
Right.
saw 100% increase in active listings. You don't think that's going to have an impact on prices eventually? Don't talk to me about
Right.
the number today. Las Vegas, it's had 2 record months, 325 and 328. You really think Las Vegas is going to continue to have record prices for single family homes when you have 20% of the unemployed? I don't think so. So
Right.
you need to watch all
And
of
that's
this stuff.
your point. It's kind of a self-perpetuating cycle. So as taxation is more friendly, businesses go there. And as businesses create jobs, people move there. And as the tax incentives for people to move there and live there are less, more and more people live there. Guess what? Those are the economies that are going to thrive. And so, it all comes still back down to, the taxation and the business, the jobs available and the population growth. And those are the areas that you want to invest in.
Yeah. And again, I don't know if you saw this, but Amazon just said they're going to invest $1.5 billion in 10 cities around the country because they want to get out of Seattle, right? Seattle's taxing their employment base. So they're like, all right, forget you. We're going to go invest $1.5 billion in 10 other areas. And what is that going to do? That's not going to have any impact this year, but that is sending a signal. And oh, by the way, the next Amazon will probably not be created in Seattle. They're going to position it in some other more friendly business environment. And that's the same thing for the Silicon Valley. We've been spoiled, just spoiled with what we've had here. But this work from home, this let's tax the rich, let's tax success, it's going to fundamentally change. And the next Uber, the next Twitter, the next whatever probably is not created here because why would you, right?
Right.
You're going to create it somewhere else.
Exactly. Exactly.
So, yeah. This is going to be an interesting decade to be an investor because again, higher taxes, inflation, asset inflation, fundamental choices about where to invest, what to sell, what to move to. Both exciting and nerve-wracking at the same time.
Exactly. It drives home the importance again of diversification, like we've talked about. If these companies are going in 10 different locations to set up shop and to do well in conservative areas, find properties in more than one location. Yes, start out in your backyard, buy one rental at a time, close to you as you can.
Mhm.
But as you can and as you have funds to deploy, it's time to start looking at diversification and putting your money in some of these other areas that are growing, because that's where you have the best chance of the upside, continual income,
Yeah.
and tax favored investing.
Yeah. Well, Anna, I want to thank you for this conversation. It's always fun. I look forward to this every week. Any closing comments for folks?
No, just, this is a great time to be a real estate investor still. So even though there's some unknowns, even though there's some things, we learn by looking at what's happened in the past. We see where things are going and we pivot and make adjustments as we need to. So I'm really excited about the opportunity still to invest in real estate. I'm still on a buying spree. I'm on a selling spree. I've sold a couple actually this week, but I'm doing that so that I can then kind of diversify into other areas. So don't let these kind of conversations scare you and go, oh, I don't want to be a real estate investor. They're really, intended to spark you to think as a wiser real estate investor and to make some different decisions on the kind of things you buy, for today and what we see coming in the future.
Very cool, Anna. Thank you very much for this. It's always fun. Have a great day.
You too.
Thanks.